Welcome to 2022. We're in the aftermath of a global pandemic. Wars broken out in Europe, leading to energy rationing, and inflation means my rent went up 55%. Seriously, can it get any crazier? Maybe. That honestly wouldn't seem out of place. However, it would be quite the way to go today on my birthday of all days. Despite this, stocks and crypto have begun peeking their heads out from the rubble, leaving many investors to assume that the downturn is over. It's only up from here. Are they right though? Or are they butting heads with the cold, hard facts of reality? Let's dive in. Beyond the chaos I just outlined, the S&P 500 has a little bit of a problem. Historically, it's been incredibly strong, growing in a mostly consistent upwards trend. But when we look to the last year, things start to change. Year-to-date and 6-month tracking has the market going south. But last month, it all flipped. 1 month, 5-day, and 1-day prices all show the market looking like it's jumping back. People everywhere are suggesting we have a rally on our hands. This means if you're a smart investor, now's the time to buy, right? Get some deals on stocks that can only go up in value. Well, like most things in investing, the situation is trickier than that. It's an enormous risk to assume that the bottom has 100% been reached. The last thing you want to do is invest all of your cash only to find out it's a false rally. So to get a better understanding of today, we need to look at some historical facts. Have we been here before? And let me tell you, in investing, that answer is always yes. Kind of. It's like that quote, history doesn't repeat itself, it rhymes. This exact thing hasn't happened before, but we have plenty of comparables to look to. Okay, history. If you've ever looked at a stock market graph from any period in time, you'll immediately notice one thing. It doesn't move in straight lines at all. The second thing you'll notice is that drawn-out sell-offs often feature inspiring rallies that shoot up, fizzle out, and return to the sell-off. Despite this, our situation right now is kind of rare. It isn't often that the S&P sees a 7.5% loss, then gains it back 1 month later. It's actually only happened a handful of times since Europe was in an all-out war with this guy. But it turns out these few occasions were all fantastic buying opportunities. Guess what the average return was for the S&P 500 just 12 months after those dips? 30%. Yeah, like I said, a fantastic opportunity. So it's an excellent time to buy, right? Well, it's never that simple, because false rallies also happen. The Depression era saw a few that would have been devastating times to buy. Plus, if we look at the more recent turnarounds in history, they've been in response to the Fed aggressively slashing interest rates to stimulate the economy. And here's the thing, the Fed just increased rates, so there's no reason to assume they'll cut rates again anytime soon. So if the bottom is in, and this bounce back really is a full-on bounce back, then it's based heavily on faith in the Fed. Can investors really be that confident? Let's look at what's actually going on. The Fed put an iron grip on monetary policy to help battle some of the most staggering inflation we've seen in decades. But this same approach increases the odds of a recession, or a slowdown, or whatever term we're using these days. Whatever it is, nobody wants it to happen. But the head of the Fed himself, Jerome Powell, has made it clear that he thinks controlling price stability is far more important than avoiding a recession. Still feeling confident? Let's look at some other factors that suggest the market won't keep rallying. Then we'll talk about a game plan. First, policy uncertainty. To make decisions, the Fed needs reliable data, and there's a hell of a lot of unknowns floating around right now. As I outlined at the start, 2022 has been insane, and the market hasn't accurately reflected that uncertainty. And second, policy lag. The effects of Fed decisions take a long time to reveal themselves, so we aren't going to feel the tighter financial conditions for quite some time. But it's also worth reiterating an earlier point. We can't be certain which way the market's going to go. Will it bounce back or keep tumbling? Is there any evidence to suggest things might be going well? Actually, yes. Now take a look at this ISM graph. It actually has some good news for inflation, which if you've been reading any headlines for the last few months will come as a total shock. The graph tracks a manufacturing survey that monitors prices paid by purchasing managers. Now what's interesting about this is the survey tracks pretty closely with producer price inflation. So when it goes up, inflation tends to do the same. When it goes down, inflation tends to do the same. This brings us to right now. At one point last year, the ISM was tracking at around 90, but after a massive fall last month, it's back down to 60. So if you want inflation to fall, which you do, then this is good news. It's hard to say exactly why this is happening. It could be supply chain pressures are finally easing up or demand is evaporating, but either way, it's one good sign that things are making a turn for the better. Positive, right? Well, let's also look at bonds. Not that one, the boring ones. What are they doing in all of this? Well, if you look at the yield curve in the bond market, it does seem like a recession is bearing down on us. Check out this chart comparing the 2 and 10-year bond yields. It doesn't go negative often, but when it does, it means a recession is very likely. The reason why is the bond market is all supply and demand. In normal times, a longer-term bond pays a higher rate than short-term ones because your money's locked away longer. However, when investors think the economy is going down the toilet in the immediate future, they want out of short-term bonds and dive into the long-term ones. Then, when it gets bad enough, the long-term bonds actually pay less than their short-term brethren because everyone thinks the short-term economy is on life support. Now, let's zoom in even closer than 2 years. If we look at the 3-month 10-year yield curve, we can get an even better idea as to whether the recession is squatting over us, threatening a tea bag. Why? Because the 3-month 10-year yield curve really only inverts or goes negative when an economic slowdown is beating down the door. So how does that curve look? It's not good and dangerously close to inverting. Okay, so what about gas? Well, aside from the fact that Europe is rationing it, gasoline futures are floating around where it was before Ukraine got invaded. And this is good news because prices are just now starting to settle down. But that being said, gas is only one piece of the economic puzzle. It's not going to help your average Joe with problems like raising rent 55%. However, they might, if you're optimistic, improve overall consumer mood, which we also need for the economy to turn. Now, I hear you saying, what about crypto? What are digital currencies doing during all this mayhem? Well, 2 of the largest cryptocurrencies, Bitcoin and Ethereum, are still down by 50% from their highs. But they both had significant rallies in the past few weeks. Does this mean for crypto that the bottom is in and it's all out buying time? Not exactly. There was an idea in crypto for a while that it's its own separate universe unaffected by traditional finance, and that's just not true. The world, inflation, stocks, interest rates, they all influence crypto whether we like it or not. Sure, crypto has its own influences, like Three Arrows Capital just completely collapsing, but if inflation is skyrocketing and the S&P 500 is all over the place and consumer confidence is a mess, it's not unreasonable to assume that crypto will be a little uncertain as well. So in these uncertain times, it makes sense to treat crypto with even more caution and expect more volatility. It looks like war, inflation, and shifting monetary policy aren't going anywhere anytime soon, so we need to consider those. Now, where does this leave us? Is the bottom in? Is this a good time to buy? And is a giant asteroid going to smash into Earth and release a swarm of terrifying alien parasites? Well, it's impossible to say for certain. I can give you my overall feel of the markets. In every bear market, there are rallies. Many of them are fake though, and they look a lot more enticing than they actually are. Michael Burry recently tweeted about the NASDAQ rallying 20% and how that doesn't mean we're in a bull market. Because that actually happened 7 times after the dot-com bubble crash while continually falling for an additional 2 years. And here's why I'm skeptical about stocks. We never saw amazing deals. Every week, I browse the market looking for value stocks that are underpriced. And while sure, prices did decrease a bit, we just never saw a period where there were spanking deals everywhere you look. And that's what you would expect in a true downturn where there's just absolute blood in the streets. That says to me, at the very least, fear in the stock market didn't hit bottom. Now, crypto, to me, that might be a different story. I think fear in crypto hit an all-time low. Investors were literally labeling it garbage. To me, that's a hallmark of an oversold asset, blood in the streets. But here's the thing I just can't stop thinking about. Sure, maybe crypto hit bottom and stocks didn't. However, if stocks are yet to hit bottom and they eventually do, they will take crypto with them as fear will eat up every market. So the solution in my mind is to invest slowly and patiently. We're starting to see the light again in these markets. People are getting up, dusting themselves off, but it may be a little while before we're completely in the clear. A few metrics to keep an eye on for the next bull market are consumer sentiment, those yield curves we talked about earlier, and whether the Fed begins letting up on interest rate hikes or not. Or maybe you could join our finance membership club, Finova. There, our goal is to provide you with all the data you need to succeed in any market environment. We do this through live coaching every single day, research reports, a huge community of investors, and trade signals to give you investment ideas, all for less than the price of a Chipotle bowl with guac. Finova will be linked down below. Oh, and yeah, the asteroid. I'm sure we'll all be fine.